Hey guys, welcome back. Paul Litchfield here with Litchfield Financial. In our last video, we talked about the 4 pillars of personal financial planning. And what I want to do now is take a deeper dive into the first pillar, investment planning. Now, I get this question all the time. People will ask me, hey Paul, how should I invest my money? What should I be buying? What should I be selling? And the answer is, it depends. There's no one-size-fits-all solution. It starts with an individualized, needs-based assessment. So what I would recommend you do is gather all your financial information, from your tax returns to your estate docs, to your bank accounts, your real estate holdings. Gather it all up into a net worth statement. And then as you're reviewing that, I want you to think about, what do you want your assets to do for you? Are you trying to grow your assets? Are you trying to protect your assets? Are you trying to do a combination thereof? Or are you trying to do something completely different? Okay, only after you have an objective in mind can you move on to portfolio construction. Now, once you're ready to enter the portfolio construction phase, there's a couple of key factors to consider. Number one, what types of assets are you dealing with? Non-taxable assets or taxable assets? Okay, and I'll give you a couple examples of both. Examples of non-taxable assets are 401ks, IRAs, employer-sponsored plans, qualified plans, things of that nature. Examples of taxable assets would be individual joint brokerage accounts, your bank accounts, trust accounts, things of that nature, okay? And it's important to understand the distinction, because you might not put a security in an IRA that you put in an individual account, right? There's differences there. The second thing you want to factor into the equation when you're looking at portfolio construction is diversification. Now, you're all probably familiar with the old adage, don't put all your eggs in one basket, especially if you're not a sophisticated investor. You probably don't want to get involved with taking on significant concentrated risks if you don't know what you're doing, right? Number 3 is performance. And I see people make a mistake with regards to this factor. What they'll do is they'll look at a security, you'll look at the past performance, and they'll pick that security solely based on the past performance, right? Well, what you should know is that past performance is not necessarily an indication of future performance. So what security did well in the past might not do well in the future, okay? The fourth thing you want to look at is cost, okay? Now, with the advent of these robo-advisors back in 2010, they've done such a great job of marketing to psychology of people. You want to have low costs, you want to have low costs. But what I would recommend is, yes, factoring costs into the equation, but looking at all the factors together to try to determine, what portfolio aligns with your needs and objectives. You don't necessarily just want to have the lowest cost portfolio, because you might be giving up things in other areas. So take a look at your net worth analysis, review it, think about your needs and goals, and then try to come up with a portfolio that aligns with those needs and goals. Let me know how you do. If you need help, feel free to reach out on the website.